The steps to accounting, except number 5, and that's what we're going to focus on today, the financial statements. The financial statements are not difficult. The difficult stuff was just deciding what accounts to use and then doing the adjusting journal entries. The rest of it's just moving some numbers around, putting them in different orders, putting them in straight lines like debits and credits. And then today what we're doing, the financial statements, they're done a little bit differently. One of the things with financial statements, this is what the public actually looks at. Anybody in the public. This is what the public would view. If you're a private company, if you grant them access to it. If they're a public company, like Walmart or something, they have to post theirs however often they do, quarterly, and for sure yearly, for you to look at, if you are an investor, especially. But you're not gonna see their T accounts, and you're not gonna see their journal entries. That's all in-house stuff. This is the only piece that you're going to actually view. Of course, these up here are done every single day. T accounts, journal entries. All these are done at the end of the year, usually, maybe in the quarter, but at least the end of the year. And then as soon as you get down here, and what we're going to look at today with Davis Park, you get done with the closing entries and the post-closing trial balance, you go right back to the beginning next year and start over with the new T accounts, new journal entries. When we're looking at the financial statements, there's 3 of them. And they have to be done in that order that I have them listed. Just get used to this order. Income statement, it's always first. And then the connector, what I call the connector, statement of retained earnings. It connects both. And the balance sheet. You've probably at least heard of some of those terms before you even came to this class and started accounting. Every account up here that you have listed will be used once, somewhere. With one exception, kind of, is retained earnings, because retained earnings gets modified throughout the process, and we actually use 2 retained earnings twice, but that's one of the only exceptions. When you're looking at for the financial statements and you're like, what goes on the income statement? It's really pretty easy. The income statement is everything over here. Any revenue, any expense accounts, they go to the income statement. We'll see how drawing fits in. Drawings is kind of by itself. Drawings goes to the statement of owner's equity. Statement of retained earnings. Besides drawings, everything else over here goes to the balance sheet. It's one easy, quick way to remember what accounts go where. And then it's kind of just simple formatting after that. And that's what I want to look at first, is the formatting. I'm going to do just real rough form of how each statement looks, and then we'll look at proper presentation when we go through Dr. K's. We'll be getting back out Dr. K's, what we did a week or so ago, looking at the adjusted trial balance that you should have from Dr. K's. With the income statement, the first thing we start with, you always list your revenues. We'll have, again, I'm going to look at presentation, how it looks better in a minute, but just to get the bare bones. You always take your revenues first, and then you subtract out your expenses. Revenues minus expenses equals your net income. Key terminology in accounting or tax. Net income. How much money did your business earn this year? If your expenses happen to be larger than your revenue, which is not good, obviously, we call it a net loss. And usually you put it in brackets to show that it's a negative net loss. Pretty simple, the income statement. Not a lot to it. Revenues minus expenses. Notice these two, just to kind of give you a little snapshot here. These two, you close to your income summary. Number one, number two, to get closed out to your income summary. The statement of retained earnings closes the other two, or it has the other two items. And we'll see that. So the income summary is basically your revenue and expenses, your net income. Statement of retained earnings. You always start with your beginning retained earnings. What was your retained earnings before you do any changes? Before you do any closing, anything else? What are your retained earnings? And then you need to add in your net income, which is basically adding in your income summary. This would be like closing entry number 3 when we close out our income summary. After you add in your net income, you subtract out your drawings or your dividends. This would be the 4th and final closing entry that we had. All the closing entries are on the first 2 statements. You combine all of this and you get your new updated ending retained earnings. This number will equal what your T account shows after you've done your closing entries. Again, not that hard of a statement. That one just has 4 things. This one could have a lot if you have a whole bunch of expenses, but still only 2 main categories. Finally, the balance sheet. Basically everything that's left. But let me make one note first. How every statement here connects. That's why you have to do them in order. You have to have the income statement done because without it you can't do the statement of retained earnings. If you don't have the net income, you can't do the statement of retained earnings. And we're going to see how this statement then connects to the balance sheet. If you're doing the balance sheet on regular line paper, that's fine. Or you can also do it on journal paper. If you're doing it on lined paper, cut your paper in half. And we're going to have 2 sides being used. If you're doing it on journal paper, it's not convenient to do half and half, so you're just going to have everything straight down, which is fine. Either way is perfectly fine. But if you're doing regular line paper, make sure I would cut it in half. It makes it visually, you can see how everything fits. With the balance sheet, we always start with our assets. And we break them down even further. And we look at specifically our current assets. Any assets that change within a year. And we're pretty used to those from our accounting equation. You know, basically anything above the PPE items. So we would list each of them. We would list our cash and its balance. We would list our AR. And I'll put here combined. Because we're going to combine, if we have 4 or 5 different people who owe us money, on our T accounts we're going to list it. We're going to show that T. Smith owes us money, and T. Jones, all those other people we've worked with so far, we're going to have each account listed for them, for our purposes. But for the public purposes, they don't need to, it's none of their business who owes us money. They just need to know that we have that money coming in at some point. So we'll just combine them all. And then we're going to list out all the rest of them. Prepaids, inventory, any other current assets. And then we're going to have a total. I'll tell you why in a minute once we get to the liabilities, why we total and separate our current and non-current. So we'll have a total over here of total current assets. Trent, will you switch the lights so this one's off and this one's on? Yep, good. Then we have our non-current section. And we're going to list here anything PPE. Any PPE items. So if we have equipment, we're going to list equipment. And then right below it, the accumulated depreciation that goes with it. Of course, this number will be a negative. Accumulated depreciation is a contra. We're going to list each one. So if we had a building, we would list it next, and then its accumulated depreciation. And then we're going to, once we've got them all listed, we're going to total our non-currents. And then the big number, the one that we're going to use to compare later, total assets. This is a biggie, important number. That total assets better equal what your T account showed as total assets. Shouldn't be any different. Any questions on the balance sheet, how it's laid out so far? That's half of it. The other half, we start.
I have a question real quick.
Okay.
Sorry. Are you adding all that stuff up for the total, or are you subtracting it?
Oh yeah, we're adding it.
You're
Adding all the total,
current?
and then the only thing we subtract here are the negatives.
Okay.
So we're adding all of these, and then we're adding these guys, and then the two total non-current, total current, we add them to get our total assets, our final figure for that side.
So you're adding current and non-current, is that right?
Mm-hmm. Yep. Add these two together to get total assets. Liabilities look very similar to the assets. They just don't usually take up as much room because there aren't as many. We have our current liabilities, and we would list things like accounts payable, wages payable, unearned revenue, interest payable, all the different items you may have, and then we're going to total them. We'll have a little total box over here. And then we list our non-current separately, and generally these would be our notes or our mortgage, listing our note payables, our mortgage payables, things that we're not going to pay off within a year. We want to keep those separate. And then just like with the assets, total our non-current, and then have one big total over here for total liabilities. Again, adding up our two non-current, or our non-current and our current to equal our total liabilities. Now, the reason why we break these up between current and non-current, and it's better when there's numbers involved. If I'm looking at just my assets and I tell you I have 100,000 in assets, but 90,000 of them are right here in our long-term things that are tough to sell. So if I need immediate cash, it's going to be hard for me to get any money. I only have $10,000 of stuff up here. But I look over here in my current liabilities, and I have, say, 20,000 coming due in current liabilities that I'm going to be probably paying off or having work to do real soon. And I only have 10,000 up here. That's not a good sign. And that's what that's what investors want to see and what company managers want to know. Do I have enough current assets that are cash or are going to be cash soon to pay my most recent upcoming bills that are coming due real soon? There are ratios that accountants use, and we'll look at those towards the end of the semester, and you look at those in the next accounting class as well. I'm not going to talk about those today, but there are ratios that go along with that the accountant may say, what's the current ratio of this company, or the quick ratio? And that's one of the reasons why you break things up like this in current and non-current. The last category, well, it's the only thing left. Owner's equity. I've taken care of my revenues, expenses, assets, liabilities. The final thing, owner's equity. And really the only two accounts we haven't used yet, capital and retained earnings. And you say, wait, we've already used retained earnings. Well, kind of. But we had a change in retained earnings. We used retained earnings, but now we've got a new number. That new number is our connector. That net income connects to this sheet. Retained earnings, our final number, we are now using our new retained earnings number in the balance sheet. Not the old one. Can't use the old one. It's outdated now. You got to use this brand new retained earnings number. Notice the one account that I left off. We do not use drawings. Drawings was used. It was used in my original numbers up here. This is a total. You can't count this as being used. It's a total number. But drawings was used already, so I don't want to use it again. I'm going to total up my owner's equity category. And the final item, total liabilities plus owner's equity. And guess what that total liabilities plus owner's equity number should look like?
The assets.
The assets, correct. Just as the equation shows. Assets equals liabilities plus owner's equity. Total assets on the balance sheet better equal total liabilities and owner's equity.